See, either of you see the PIMCO comments yesterday, riskiest credit market ever, from some CEOs now, a guy named Scott Mather, and he's talking mostly about leverage and corporates and underwriting standards are down. And
well, what do they expect? What do they expect? The central bank put a big sign in arrows, like eat here, you know, big arrows, eat at Joe's.
Yeah.
They made everybody bite into the risk, and now the risk is here. Corporate securities, what's the ECB doing? They like to buy them. I mean, everything that's going on with regard to risk, I think central banks think it's more palatable.
So you think he's honest? He says this is what we saw in 05 and 06, and we know how that.
Oh, no. Even though we're there, I don't think it's anywhere near like it was 05 or 06.
No, and I don't think so either. I think if you look at even the riskiest part of that market, the leveraged loan index is still in the high 90s. You know, you got to come way back to the 50s and 60s to get anywhere near where we were in 06 and 07. So I think that the signs, they're, you know, I know Dan's worried about credit spreads, and we're all worried about credit spreads, but the fundamentals of this still look pretty strong, and I'm not sure that we're anywhere near the last recessionary period.
So Rick, you know, over the years, it looked like the Fed was behind the curve in normalizing rates from emergency levels back to what we think of as normal. But now we've got a whole new notion of what equilibrium is, or do we? And what's causing it? Is it still central bankers gaming the system, or do we deserve to be here from inflation, global inflation?
Listen, I have to give the central bank some credit. 9 quarter-point tightenings. Okay, so here we sit.
Yeah.
How many has the ECB done? You know, how aggressive is the Bank of Japan?
So you want to go up. You're saying it's right to be raising.
I think it's right. I would have liked to have seen it higher, but they would have needed to start earlier. The biggest mistake the Fed made was starting late. Janet Yellen was late to the party with regard to starting.
Meaning you don't think they can raise rates anymore?
I think it's pretty comfortable right here. I think we're close to what would be perceived as neutral. Neutral should be higher, but I think the forces overseas and other central banks is pressuring that neutral rate.
So you're blaming it on central banks overseas? You're not blaming it on that it should be here based on global inflation or actual fundamentals?
I think all central banks made plenty of mistakes, but I think overseas, the other central banks right now are
what can they do, though?
Well, they can't do much now.
Because they got entitlement states. They got this euro system without a central fiscal authority and the same currency, and I mean it's messed up. They're trying to make that work, right?
And they have all those wonderful bureaucrats in Brussels.
Bureaucrats in Brussels, unelected, and well, Farage may take care of some of that.
I think so too.
It's unbelievable what's happening. Kevin, why are we there? Why are there negative rates again in Europe in 8 years, 9 years after the end of the world?
That's the trend in Europe for the next 5 to 10 years, I think.
Negative rates?
Well, yeah, I think so.
Because they just can't get their act together?
Well, you know, Europe runs on Germany, and if the German economy is slowing, the rest of Europe is going to slow with it. So I think that we're not even there yet in terms of where we could go with rates in the negative territory. Some 13 trillion now. Of the world's interest rates are negative. I would say, going back to the Fed, what they missed most was the call on inflation. And they base that on raising rates to 7 times where we are now. So I think them being quiet and not talking about anything being transitory is good for the market.
I mean, no one, Rick, thought 226 here at the beginning of 2018 or 19.
I wouldn't have.
You did?
I did. I came on this show in January.
Based on
all
what?
About inflation. You know, to me, the trade is the cherry on the top. We were talking about that earlier. To me, it's always been an inflation story or a lack of inflation story. The Fed missed that call. The market missed that call. The bond market got on it early. And this is just the result of that. And Friday's number, the core PCE, if we still get something in the 1.5, 1.6 rate.
How did you know inflation would stay slow? Was it based on productivity or all of the innovation we have in this economy, or China,
it goes anywhere from the sharing economy, which is, you know, Uber and Airbnb, to the fact that the baby boomers are crowding out the millennials for jobs that they'll take. that are lower wages and, technology, productivity, and all of that.
Rent, so they don't need as much.
Exactly. So that keeps it suppresses other prices like hotel prices and things like that. And this is one of the things we were talking about. It's not your father's economy or inflation, and I think the Fed is based on things that happened in the past, trying to set policy for the future. I just think it's wrong.
Rick, the rest of the market seems to think that the Fed's going to cut rates sometime as soon as September.
Well, a month ago, I probably would have disagreed with that. But I think that if the Fed's observing the markets, and equity traders in particular are very petrified of what rates are doing for obvious reasons, it's possible. I'm still thinking that they're going to be patient for a while. But you start to get much closer to 2% in a 10-year. Those are market-driven rates to some extent, even though they have such large inventories, and I think they pay attention to that.